Friday the 10th of November, European equities slide into the weekend. FTSE's down by 1.62%, CAC's down by 1.22%, luxury stocks under a little pressure. What today's session means is that we are also now down on the week as well. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So stocks down more broadly. You can see that with the stock 600. We're down by 1.21%. But more specifically to that, it is retail stocks, it's consumer stocks, it's high-end consumer stocks that are really taking the hit. Over the last decade, for as long as I've been covering Diageo, this is a company that has talked about premiumization. It has pushed up the price points slowly, but incrementally, but it's been an ongoing story for a very long time. That's been the strategy. You make more money at the top end. That is beginning to unwind now. We're seeing consumers pushing back against those high prices. You're seeing it in the Caribbean, you're seeing it in Latin America, you're seeing it more broadly around the world. But that's what Diageo flagged today, and look at the impact that it had on its stock. That stock down by, let's call it 14%. Richemont, owner of Cartier, similar sort of narrative. Wasn't in jewelry, it was in watches, that kind of area that we've seen weakness in with other stocks. We've seen it now with Richemont as well. That stock out of Switzerland down by, let's call it 5% today. The consumer, Kaylee, is pushing back. The premiumization, these price rises may have finally hit the wall.
Well, and Guy, here in the U.S., it really is all about the consumer as well. After we got UMich consumer sentiment, preliminary figures for the month of November that shows confidence is deteriorating and inflation expectations are moving up. 4.4% inflation is what consumers expect over the course of the next year, 3.2% on the 5 to 10-year outlook. As for how all of that is translating into the market, remember the S&P 500 snapped an 8-day winning streak yesterday, trying to bounce back today, up by about 0.4%. And in the bond market, while yields had been moving lower after that inflation expectation figure in UMich specifically, you saw the 2-year kind of moving back up. We're now back up at 5.01%, so essentially flat on the day. Of course, a lot of that feeds into expectations about what gas prices are going to do, or is driven by those expectations, rather. And you are seeing oil prices moving higher today, about 1.3%. We're just shy of $77 a barrel on WTI, $76.75 where we trade now. And then Wynn Resorts, I wanted to point to, Guy, this also is a consumer story, or at least a spending story, but primarily in China. The good news for Wynn is that they did reach a tentative deal with the Las Vegas Culinary Workers Union, so that may avoid a strike. The bad news, though, is in their earnings report, Macau was particularly a disappointment. Obviously a key market for Wynn, but also shows a lot of those high rollers in China, Guy, may not be really wanting to spend money on gambling. That stock down about 6.8%. And if they're not gambling, maybe they're not buying as many luxury goods as well.
Absolutely. They may not be traveling. And that certainly is ripping through this sector. Kelly, it's not just the consumer that is pushing back against high prices. Maybe it's investors as well. You can certainly see that in the spirit stocks and in the luxury stocks. Here you've got Diageo, you've got Pernod, you've got Richemont, you've got LVMH. LVMH in red, the one you kind of really want to focus on. The nervousness surrounding this sector has grown throughout the year. At the beginning of this year, this sector was on an absolute tear. But we've since then really retrenched. And recently, you can see this sharp tick to the downside as consumers feel the pain and then investors feel the pain, Kaylee.
Absolutely. And of course, Guy, we had a long conversation on the consumer last hour with Joanne Shu. She is University of Michigan Surveys of Consumers Director, and she talked to us about sentiment. Here's what she told us.
There are a number of factors that are really weighing on consumers. The persistence of inflation is one, of course, and consumers do appear to be worried that inflation is going to pick up again in not just next year, but in the long run as well.
And it was interesting, Joanne, talking about the fact as well that the upper-end consumer, the consumer that tends to buy luxury goods, very much correlated to what is happening with financial markets. At the moment, they seem okay, but any cracks that appear, that is when the pain really could come home to roost. Our question of the day is, though, a fairly straightforward one and feeds off all of these narratives. Is this time for the last call on the consumer? Joining us now, Angelina Rasque, who covers EU luxury for us here at Bloomberg, and Justina Lee, Bloomberg's global cross-asset reporter. Angelina, I'm going to start with you in Paris. We have seen price rises for high-end spirits, for high-end luxury goods, year after year after year. Are we finally at the point where the consumer is pushing back?
Yes, exactly. That's exactly what's happening, Guy. I mean, for the past 2 years, we saw the beginning of inflation, and these luxury brands, whether it's Chanel, Christian Dior, or Moët et Chandon, they were increasing their prices because actually, consumers were happy to spend on that. It's at the end of the day, it's discretionary spending. People were getting out of lockdowns. They were happy to spend to treat themselves. So we saw that for about 2 years, and the cracks actually starting to appear initially at the start of the year with the drinks and spirits sector. We saw it at LVMH in the US, people starting to push back against price hikes in cognac NSC price, for cognac NSC. But now what we're seeing at Richemont today is that they're actually seeing pushback against, increases in the watch segment. So all in all, it's consumers saying, not anymore.
Well, I guess, Angelina, the question, and you mentioned there how there is some pushback on U.S. consumers when it comes to some of these spirits, for example, which consumer it is primarily that is starting to do it. If it is the U.S. consumer, the European one, or the Chinese consumer, which one, Angelina, is the most concerning for these companies?
I mean, initially at the start of the year, it was definitely the U.S. The U.S. Grew a lot in 2021 and 2022, and at the start of 2023, we're starting to see a major slowdown. We were hoping China would spend a lot in 2023 because, remember, a good part of 2022, they were actually in lockdown. And actually, they have spent, but they haven't spent as much as expected. And in Europe, we're seeing something, a slowdown as well. So overall, I think we're all heading in the same direction. It's a normalization. It's more sober types of consumption. I mean, in Q3 results, LVMH, for instance, it's still growing, but at much slower pace.
Justina, is this a reset? You talk about normalization. Angelina talks about sort of a reset back to maybe a previous time. But these are stocks that Europe has relied on. This is an industry that Europe relies on. If the bubble is kind of fading, if the fizz is fading from the luxury sector, what does that mean for European equities? What does that mean for European markets?
I mean, it is pretty worrying because I always come on the show and I talk about how the European market is like unloved and, a value market. Yeah. But the one corner of it where it's almost like the U.S., the equivalent of the U.S. tech stock is actually luxury because you can always count on that part to grow their earnings regardless of the economic environment. And I think you're kind of starting to see this narrative crack, but maybe not in like every luxury stock, because we're still seeing that in like your kind of the highest end of the bar, right?
Still okay.
And Hermes, exactly. I mean, maybe you don't get kind of the big spikes in profits, but then, I mean, they're really clinging on to their brand value. But I think kind of over the past couple of days, we've kind of seen the aspirational consumer is cracking, and that's affecting, and kind of a broadening segment of the luxury sector.
Well, and Justina, thinking about this from a macro perspective, especially as, Angelina was just outlining, you're finally seeing some of the pushback, consumers not willing to be spending more at higher prices. Isn't this what central banks are trying to orchestrate? They want to see this come about, consumers not just continually accept higher prices. Does this make it a little easier for the ECB?
I think that's right. And if anything, I think a lot of central bankers, especially the Fed, were probably scratching their heads and wondering kind of why inflation has been so resilient. And one explanation that's always proffered, at least in the U.S., is that people have saved up a lot of money during the pandemic, and so consumer demand has been unusually strong. And in fact, I mean, just a few days ago, I guess another counterpoint to this debate is that there was a study out of the San Francisco Fed saying that maybe these pandemic savings can last till kind of the middle of 2024. And so I think that, obviously, economists and central bankers always talk about, they want a soft landing. But the question here is, that's kind of historically been hard to pull off. And that's why I think you kind of still see the Fed emphasizing that they kind of have not entirely relaxed on the inflation fight just yet.
Angelina, if luxury companies are going to see their top line being pressurized, are there costs that can be cut? Are these the kinds of companies that can cut costs? Because if they cut costs, doesn't it slightly undermine the whole central case of wanting to buy them? It's all about craftsmanship, etc.
they have room for maneuver. I mean, if you think about a big chunk of their costs, it's what they call advertising and promotion, and actually that's actually an expense that goes up as sales go up, because the more clients you have, the more salespeople you're going to have. So actually, and also the more media campaigns you're going to be doing, the more VIP events you're going to be doing. So that will naturally adjust itself. However, if you're thinking about headcount, I don't think that's going to happen, because historically LVMH, for instance, has never had a round of layoffs, as opposed to the tech sector, for instance. So right now, it's a company that has about 200, as of last year, had about 200,000 employees. I don't think this is going to be a place where they're going to be looking at. However, yes, you can slow down spending on advertising and promotion for sure.
All of this has me thinking about the holiday season, because people will be out there shopping for Christmas presents. And Justina, that brings my brain to a second thought, which is whether or not we're going to see a Santa Claus rally into year end. As we're getting closer. We only have about a month and a half to go. If we're seeing this kind of slowdown in different parts of the economy, can equities be powered higher? Are we likely to see that?
Yeah, that's the big question right now. And I think it goes back to the fact that a lot of stock benchmarks at the end of the day are not really about these consumer stocks. They're about big tech. And I think an interesting debate that's going on at the moment is that if you're more worried about the consumer, should you be kind of buying more of these Magnificent Seven tech stocks, which have kind of really posted very resilient earnings in kind of the last season. And so if the narrative is that these are actually really defensive stocks, despite their high valuations, despite their volatility, then maybe we're still going to get a pretty strong kind of rally going into year end, or at least for the U.S. market.
All right, Justina Lee and Angelina Rascue, thank you so much to both of you for joining us. Coming up, we're going to get more insight into our question of the day. Is it the last call for the consumer? Maria Vaitman, State Street Bank's senior multi-asset strategist, will join us next with her answer. This is Bloomberg.
The economy is softening in a healthy way, in our opinion. This is what a soft landing looks like. And because of that, we actually think interest rates are at or close to the peak. And I know that that sounds a little contradictory based on really recent data, but there's so much recency bias right now in market movements.
Angie Newman, Managing Director and Portfolio Manager at UBS Private Wealth Management, speaking to Kaylee and me in the last hour. Takes us back to our question of the day. Are we finally seeing the last call for the consumer? Joining us now, Maria Waitman, Senior Multi-Asset Strategist at State Street Bank. Maria, what do you think? We've got Diageo down today, we've got Richemont down today. The UMich data painting a fairly grim picture of consumer expectations as well. Is the consumer finally cracking?
Yes, I think it's an interesting question, Guy. What we saw, and I think this is the way I think about it, is that if you look at excess COVID savings, and okay, aggregate number has been quite large, but if you split it by income level, so low-income consumers, they spent the COVID saving about a year ago, and we had profit warnings for Walmart and the Target of this world. Now we're getting a middle-class consumer having spent all the excess savings, and we're getting profit warnings from luxury goods as aspirational kind of buying going away. So it's really only the high-end consumers that still have savings. So I think that's kind of sequential running out of saving is way to think about it. So there is kind of winners and losers, and now we're moving higher and higher in terms of who still has money to spend, and there are fewer and fewer of those people.
Okay, so Maria, with that in mind, where are we in the soft landing scenario that we were just hearing about? What is your expectation in terms of recessionary vibes or not?
Well, I'm firmly in a recession is very hard to avoid camp. So I think I'm probably more into hard landings than soft landing. And to me, it's still labor market. Labor market is still very, very strong. And that keeps going. And the other factors that I'm watching very closely is availability of credit. for now, it's still possible for people to access credit. It's expensive and it's getting tougher, but it's keep going.
Yep.
And I think that's kind of somewhat inflationary, and that means that Fed is not going to come to our rescue and cut rates, which keeps rates higher for longer, and that will create a much deeper recession.
Maria, I listened to Jay Powell. He didn't sound Jay Powell didn't sound 100% convinced that he's got inflation under control, and I guess the UMich data kind of points to that as well. Do you think central banks have done enough at this point? It sounds like you're suggesting that maybe they're not restrictive enough.
Yeah, I think that's exactly what we're thinking. I think, to me, University of Michigan is probably one of the things that we should keep very, very close eye at. And it's really not showing us that we're in a good place, stealing Jay Powell's from last week when market got excited. So, no, we're not in a good place. And I think, Ray, it's absolutely too early to think about cuts. And I mean, just think back to Q3 GDP, 4.9%. That's not a cut territory at all.
Okay, so if it's way too early to think about cuts, does that mean don't touch this bond market with a 10-foot pole?
Don't touch bond market. Don't touch stock market. So it's not much you can touch.
So don't touch
cash. Cash into the year end. Try to spend. Support consumer.
What do you need to see to change that?
So no Santa. Santa's not coming, Maria.
Santa's coming. I mean, I'm afraid to be a bearer of bad news. So, but it's probably, to me, it's more Grinch than Santa.
Okay. Well, that will play. I get called the Grinch on this team because, well, for many reasons. But anyway, that kind of fits with the narrative. So you talk about cash. What would it take you to get out of cash, Maria?
Oh, that's actually a tricky one because our medium-term outlook is quite negative. I think what we are trying to kind of find ways to talk to clients about is relative preferences. So within equity, so if you're an equity investor, so we actually do like tech. We like large cap quality, we like safety. So that type of kind of relative preference, that's quite interesting. So maybe tech versus industrials, or maybe healthcare relative to financials. So that types of trade we actually like. So I don't think it's outright buying stocks, but finding like good opportunities within stocks. And I hate saying value because I don't think value is a good investment strategy, but like opportunities.
Well, when you say within tech, because what we hear often is that people don't want to touch tech, just maybe very specific parts of it. Where within tech do you think is the safest place to be?
Yeah, no, that's an interesting point because very often I mean, I'll pick up on kind of your earlier point is people don't want to touch tech because it's expensive and crowded, which we absolutely agree with. But our point is that you actually should not be buying value when we're about to go into recession. Because, I mean, at that point of time, where it's the worst time for value. You buy value when things are improving. So, yes, tech is expensive, tech is crowded, but it's those large caps, very kind of mega caps and with business models that almost kind of monopolistic that allow those companies to maintain earnings, to protect margins relative to their peers that you should be buying into. So it's really this crowded, expensive tech that you probably will continue having some positive momentum.
Maria, what do you think about oil stocks? Huge volatility in crude right now.
I mean, oil stock, again, it fits, again, not in absolute terms because we vary of stocks, but in terms of relative preference, again, those companies generate, I mean, they're one of the best free cash flow generations, right? So they have cash. And that's quite unusual in kind of our, at this stage of the cycle. So they have money, they can, I mean, pay dividends, do buybacks, their balance sheets are strong, they're protecting margins. So yes, huge volatility, absolutely agree with you, Guy, but medium term, I think that's the right type of stock to own and at the current point in the cycle.
All right, Maria Wittmann of State Street, thank you so much for joining us. Also, great shirt. It's a good reminder that it's Friday. The weekend is almost here. We're almost there, but we do have a little bit more show left to get through, so make sure you stay with us. This is Bloomberg.
So tomorrow, I'm off to Dubai. The reason I'm off to Dubai, the Dubai Air Show, is starting Monday. basically bringing together most of the people from the aerospace sector and the aviation sector. Now, this is a business trip for me. But Kaylee, Singapore Airlines, this is an interesting story that came out a little bit earlier on, basically saying that tourists, not corporate travelers, which would normally be flying at this time of the year, are filling up their pricey first class and business class cabins, which I think is really interesting in light of what we've been talking about, which is that the consumer is starting to crack. Even the high-end consumer is starting to crack. So if they're spending less money on Richemont watches or Diageo booze, are they still going to be spending on traveling at the front of the plane? And if the pandemic kind of boom in you only live once kind of travel is starting to fade, what does that mean for these airlines?
Yeah, I think that's a really key question because we still are seeing relative resilience in the experience economy, right? People didn't do a lot during the pandemic.
Yep.
They built up a lot of savings as a result, and that's where they've been willing to spend their dollars or their euros or what have you. The question is, Guy, to your exact point, if we're starting to see that people aren't spending money on the tens of thousands of dollars watches anymore, they're becoming a little bit more pricing sensitive. Is that ultimately going to impact the travel space as well? And all of that pent up demand finally runs into the it's too expensive and we don't have a lot of savings wall.
Yeah, you wonder whether this is going to hit Europe next year. Europe had a fantastic tourist season because Americans, like Alex Steele, spent the summer here. And you do wonder whether or not that is still going to be the case going into next year. Are we finally starting to hit the point where price is having a big impact? It's certainly a question that I'm going to be asking at the Dubai Air Show. We've got some great guests lined up over the next few days from that air show. Stan Deal's going to be joining us on the civil side from Boeing, Ted Colbert on the military side. This show could also be dominated, particularly given where it is, by that military story. So it's going to be fantastic to get Ted's take. Tim Clark, are we going to see a big order from Emirates? We'll be asking that question. Tony Douglas is going to join us from Riyadh Air. And we've got the CEO of Etihad as well. What is he doing right now? He's come from Portugal, and it's going to be interesting to see what he's doing with that business. Antonio Neves joining us from Etihad. I think we're going to be talking to him late Monday afternoon. So some great guests lined up to talk to us about what is happening, and are we finally seeing the consumer cracking, and what does that mean for the aviation sector and demand for aircraft? Before we get to that, though, we need to wrap up the markets. And I just want to kind of flag a few of the 52-week lows that we're seeing today. Carlsberg, Diageo, we were just mentioning. ITV, we were talking about the ad spend story. ITV is down really sharply today at a 52-week low after its numbers. Burberry out with numbers next week. It is under pressure as well. 52-week lows. All of that kind of evidence, isn't it, that the consumer is starting to come under pressure. These stocks, very consumer-focused, and you're seeing that cracking story maybe developing there as well. The close is next. This is Bloomberg. So wrapping up the session, we're wrapping up the week for European equities, and the message from both of those two durations is the same, down. Look at the market today. FTSE's down pretty hard. DAX is down. CAC's down around 0.9%. FTSE's down the most. A little bit of an unwind to some of the stories earlier on in the week, but Diageo is a big factor there in terms of what we are seeing. But it's a negative end to the week. To be honest, kind of Monday, Tuesday were fairly negative as well. Then we got a couple of days, sort of Wednesday, Thursday, of positive news. That certainly came to an end today in fairly sharp relief. So this is the 5-day story, as I say. Monday, Tuesday, negative. Little pickup Wednesday. Thursday, fairly solid. But look at today's session. Down, down, down. That takes us for the week to being down 0.2%. Let's call that sideways. Let's talk about some single stocks before we go and figure out what is happening here. Similar theme throughout all of them. We've been mentioning them throughout the show. Diageo down by 12.2% today. The pushback against high-priced spirits, the premiumization of this market is definitely underway. Today it was flagging the Caribbean and Latin America, but it's been a story throughout most of this year that we're seeing premium spirit pushback. People are trading down. Diageo responding to that in terms of the share price move. Richemont as well. It's not jewelry, it's the kind of the high-end watches, the Cartier story here that is really under pressure. Again, it's the price point. People are pushing back. They're not prepared to pay these high prices. We've seen a significant inflation rate within this space, and the consumer may be finally signaling they've had enough. How does that reflect in terms of the ad market? ITV's that story there today. Look at this. The UK broadcaster under pressure, flagging weak advertising sales story going forward from here. Now, it's exactly because of these kinds of companies that aren't going to be advertising in the same way going forward that we're seeing that. It's also, Kaylee, a kind of representation that forward-looking story on the ad spend story from ITV about what is happening with GDP. Now, GDP today out of the UK fairly weak. Next week, we're going to see CPI data. So let's talk about what next week is going to bring before we go. We've got an awful lot of data we need to work our way through. As I've already mentioned, though, Monday I'm going to be in Dubai for the Dubai Air Show. That's going to be fascinating. Again, it's maybe a similar story, the consumer, what's happening there. Airlines have been really benefiting from the high-end spend that we've been seeing. Is that sustainable? Germany, Eurozone, European GDP data Tuesday. Wednesday, we get UK CPI. So today we've got the kind of the stag bit. Maybe we get the kind of deflation bit next week. Today, basically, UK GDP drifted sideways. Thursday, Burberry earnings. Burberry today hitting a 52-week low. Friday, UK retail sales. How is the UK consumer doing? I think maybe you're getting the message at the moment that maybe the consumer is under pressure. But GDP next week, CPI next week, Kayleigh, I think really interesting in light of the GDP data we saw out of the UK today.
Yeah, absolutely. A lot of data to look forward to, but data from today, as you say, Guy, to digest as well. So let's add a voice to this conversation. As GDP shows, the UK has, at least for now, skirted a contraction. Joining us now is Catherine Nice. She is joining us from PGIM, where she's the chief European economist at PGIM Fixed Income. So, Catherine, sure, the data could have been worse. It also could have been better. If we're avoiding a contraction, or at least one was avoided in the third quarter, for how much longer can that contraction be avoided?
Well, as you say, the data very much came in line with what we were expecting. It confirms a weak picture for the UK economy. And I think if we look underneath the headline data and the components, it's again pointing at pretty broad-based weakness with the British consumer, and weakness also in investment. So that suggests that, you know, we're going to see more of this weakness in coming quarters, where the risk is potentially that weakness gathers pace. But, you know, my base case is that things are going to continue to sort of move sideways from here.
What are we going to see on the inflation front? We're getting an economy that's doing nothing right now, but inflation feels like it's coming down quite slowly. Is that going to be what the data is confirming next week?
I think we're going to see a pretty big decline in headline inflation, really mirroring the picture that we've seen in other European economies. And that's largely reflecting these energy base effects from 12 months ago, dropping out of the calculation. On core inflation, I think here too, we're going to see a bit of a mirror image, what we saw in Europe earlier this month, which is that too will come off, but, you know, much less markedly so. So definitely good news that these measures are going in the right direction. But again, if you kind of step back and you look at what is the actual number that we're expecting, you're looking at numbers for both headline and core that are going to be around the 5% handle. And that's still obviously, you know, a bit of an air gap between where the Bank of England would like to be with regard to its 2% inflation target and where inflation actually is.
Well, that's absolutely true. And with that in mind, especially if a lot of this is due to just energy base effects, how convinced would the Bank of England be by this data that they've done enough work and they don't need to do more?
My sense is that, you know, GDP data, and if the inflation data comes in line with what I described, I don't think it's going to have much of an effect on Bank of England policymakers just now. It's also going to be in line with what they expected. That said, I think if we got to next week and we saw that core inflation was coming off a bit faster than people were expecting, if we also get labor market data for the UK out, if we see there signs that the labor market, which up until now has been pretty resilient, if we start to see hints there that is weakening too, I think that, you know, more of the market might be piling into this idea of, you know, front loading some of these cuts even earlier into 2024.
When does the Bank of England have to admit that? At the moment, the message is really clearly, and I spoke to the governor only a few days ago, it's too early to talk about cuts. Isn't the Bank of England meant to be in the business of sort of not jumping around as much as it is at the moment? Isn't there a danger that it gets that it has to basically stick to its guns for longer in order to maintain its credibility, and also just to make sure that it has firmly re-anchored inflation expectations?
I think that policymakers, and I would include the Bank of England in this statement for sure, I think they're going to want to see in the data baked in that core inflation is on a consistent and compelling decline back towards their 2% target. I think they're going to want to see at the beginning of next year that nominal wage growth is easing before they even have any degree of confidence to start contemplating cuts. So, my sense is the market is perhaps getting a little bit ahead of itself. And that could gather a bit more pace in terms of expectations next week. If, as I say, we see some hints that perhaps the weakening is beginning to accelerate and hit the labor market. But I'm not sure that policymakers are in the same place. And I think in Europe in particular and the UK, especially so, where services price inflation is running way too high, even, near-term month-on-month measures are not coming back towards the target. Wage growth is far too high, 7-8%, clearly not consistent with 2% inflation target. I don't think they are going to feel confident to really start to have this conversation around cuts until they see those lower numbers in the data.
Yeah. Catherine, great to catch you up. Really appreciate it. Thank you very much indeed. Catherine Nice, Chief European Economist, joining us at PGIM Fixed Income. Kayleigh, it's a similar message in some ways we're getting from the Fed, but the Fed's kind of actively still talking about the need potentially for hikes. Maybe that's just to stop the market pricing cuts, but it's kind of, Powell's sounding a little bit hawkish still.
Yeah, and I do have to wonder if that's because he saw that financial conditions eased in the week and change since his press conference and their decision not to hike again. It seems like the market decided, all right, Fed's done here, and Powell's like, hold on, it's not over till it's over. We still need conditions to tighten.
Absolutely. And we'll see what the data brings us next week. European markets are closed. Not much action during the auction, to be honest. We're going to take you back next to the story surrounding the EV transition. So the EV maker Polestar is looking for an additional $1.3 billion in funding on its road to profitability. We are going to talk to the company's CEO. That's next. This is Bloomberg. This is Bloomberg Markets. You're looking live at the principal room. Coming up, Sonal Desai, Franklin Templeton, CIO for Fixed Income, joining Bloomberg Wall Street Week today at 6 p.m. New York time. This is Bloomberg. We welcome now our TV and radio listeners, our TV audience and radio listeners. We need to talk about what's happening in the EV space. EV maker Polestar, fresh off its investor day, a day that showcased its business strategy and future EV prototypes. We now welcome Thomas Ingerlath, Polestar CEO and Bloomberg's resident. It says gearhead, but electric cars don't have gears, so we'll maybe park that name for now. But Matt Miller joins us. Thomas, great to see you. Thanks for joining us. What's the message that you are sending to investors? What do you want to convey about where this business goes next?
Yeah, good morning, Guy. Hi, Matt. Well, our message here from our Polestar Day, how we call it here in LA, it's I think a very positive, good one. We have two major parts here. One, of course, the great news about the product rollout, and the other part about what work we have done over the last summer about the business plan. Obviously, making that a strong, resilient business plan, which means clear view on the break-even, cash flow break-even, 2025. So what I would call in a very short distance, very much in sight, 2025 cash flow break-even, and the funding need that is needed from today till this break-even, a very clear defined amount of 1.3 billion, which we want to cover with a mix of debt and equity. So what I would call a very manageable funding need. These two are the key cornerstones of this business plan, which I think everybody would acknowledge is not based on dreamy, fancy production numbers, but really a very realistic and achievable volume.
Thomas, let me jump in and ask you about those production numbers, because you've scaled back your 2023 production forecast a couple of times already. Now you expect to make 60,000 vehicles in total this year, but you need to get up to, I think, 155,000 by 2025. How are you going to make that leap from 60 to 155 in the next couple of years?
Well, yesterday people were queuing to get a ride along in our Polestar 3 SUV and in the SUV Coupe, the Polestar 4. Both cars are ready to go out. The Polestar 4 actually has production start next week. The Polestar 3 will start production early 2024. So 2024, we will get these two cars in our hands. 25 will be a year where they will be fully in customer delivery, plus the Polestar 5 joining. So 3 great cars in the exclusive segment. So this product lineup, of course, is a big reason for our increase of volume in this period.
Thomas, you just called your products exclusive. What we've seen today is Richemont, the owner of Cartier, warning that they are seeing a significant consumer slowdown at the upper end. You've got Diageo warning that its premium products are starting to hit price resistance. We're seeing it all across the luxury sector at the moment, that the consumer is saying, I can't afford that anymore, even the upper end consumer. Are you seeing any evidence of that? Are exclusive EV products going to face the same headwinds that the rest of the luxury sector might be seeing at the moment?
I think it's very important to put that in perspective. I think there's no doubt that the long-term success of electrification is given. The only way of CO2 emission reduction is via EVs. Transition from combustion engine to EVs is a clear path forward. Short-term, economic fluctuations. The industry has seen that over decades. I think the real question is, how resilient are you as a business to go through those? And I think us having presented this business plan is a clear testimony of Polestar being on the side of the winners to go through those downsides and just simply be resilient enough to get out as a winner in that. So for that reason, I don't think there's any question about the EV success in the long term.
Thomas, you've just talked to us about your new business plan that you presented and said you need $1.3 billion. You're very specific about what you need to be cash flow break even in 2025. You need that externally, that funding. Are you in talks with any external investors? What kind of outside investors do you want to hook up with? And has anyone expressed interest?
Well, look, we were always very clear about the openness to attract outside investors. Our 2 main shareholders who have been and will be very supportive in our business, of course, will stay with us, but they are very willing to have others participating in the ownership of Polestar. And that's how we plan ahead.
So Volvo and Geely, do you think the other investors, could they come from China? Are you in talks with other Chinese investors?
No, we are worldwide pitching for this, so there's certainly no preference in any regional destination where these people should come from. No, we are here, obviously, today in the US. We have US production with the Polestar 3 starting. I think that is as well a very clear sign that we are an international business open to international investment.
Thomas, you flagged the fact that you have US production. President Biden has, within the last couple of days, signaled his support for the UAW to start targeting businesses like Tesla. He thinks that maybe that's the next place that they should be looking. What do you think about your labor? Do you think you could be facing strikes? Do you think you could be facing a union push? Do you think this is going to be something that pulls in the whole of the automotive sector in the United States?
Well, Not really that much the question to us, because we have a very simple way of having basically no manufacturing footprint on our own. We have contract manufacturing with our big partners in that. Obviously, the Volvo factory in Ridgeville, we have production together with Geely. And this is where, of course, this question you have now should be targeted. We are very well familiar with factories, with unions. We have, obviously, in Sweden, a very strong base as well with manufacturing in Volvo. So I think that's really no question mark from our side onto that.
What is the Polestar, the unique selling point? Because, some brands, Porsche is about, speed and sports cars. Mercedes is about kind of luxury and status. Volvo is about, safety and family, at least for me. What is Polestar about?
Polestar main differentiator clearly is our design focus. It's a brand with strongest design as advanced as its technology. That's our slogan. And I think yesterday at our Polestar Day, when you see the lineup of the beautiful cars and how innovation is brought to the customer through our design, made it really desirable. I mean, that is how we think electrification will succeed. Cars that really make people are passionate about. And what is the greatest driver for passion is clearly the design aspect of it. So if you ask us to narrow it down to that one aspect, it's design.
Thomas, great to catch up. Really appreciate you joining us from Los Angeles. Thomas Ingelath of Polestar. And, of course, our thanks to Bloomberg's Matt Miller. Fascinating to see what he had to say about the exclusive story. Anyway, interesting conversation there. Much more still to come. This is Bloomberg.
Well, stocks are rallying, trying to end the week higher. Bloomberg's Abigail Doolittle is tracking the moves for us. Abigail?
They are indeed trying to rally and end the week higher, Kelly, because when we last looked at stocks, the S&P 500 a very small loss, but now we have the major index, the broadest index, really rebounding off of the lows today, which was a small gain, but now up about 0.7%, putting the S&P 500 on track for a second up week in a row. And the tone of this board is slightly risk on. Take a look at Bitcoin, up 2.3%. Although I suppose some people would argue, and I don't necessarily agree, that Bitcoin is a haven asset. But today, let's choose to see it as the VIX or growth, and it is higher. Again, a bit of a risk-on tone. The Bloomberg Dollar Index basically flat, and the New York crude off of the recent lows, now at $77 per barrel. Now, it is down, though, oil over the last couple of weeks, taking the energy sector with it, the worst sector on the week. Most sectors are still lower for the S&P 500, so it's not a broad-based gain. It's really driven by the mega-cap tech sector, but you can see over the last few days, in fact, this week and on the month of November, it is down now about 2.7%. Now, what we do have on the day, yields, well, it's interesting because now we have the 2-year yield and the 5-year yield flipping higher. And this, of course, after those UMich forward-looking inflation numbers, consumers gauge or sense of where inflation will be in the future, flipping both the 2 and the 5-year yield slightly higher, bonds down. You can see the 10-year yield basically flat, probably poised to join the short end of the curve, and the 30-year yield still down about 4 basis points. Let's take a look at those expectations because visually it's pretty interesting. And of course, as we were talking about before, Kelly and Guy, we do have CPI and PPI coming out next week. So here we have the near-term view of inflation on the part of investors saying 4.4%, but it's the spike higher, and also here 3.2%. So we have consumers seeing inflation going back higher, and in white it is the 1-year view, and the orange it's a little bit further out, very much further out, 5 to 10 years. But in any case, folks out there in the real world, their sense is that inflation is still on the rise, Guy.
Yep, and that's critical. Our inflation expectation anchored. Do we need to see the Fed doing more? Abigail, thank you very much indeed. Okay, let's talk about what next week is going to bring. We've got plenty to talk about. We have got Sarah Lamb joining Bloomberg Technology very shortly. That's going to be an interesting conversation you want to pay attention to. But Kaylee, your week feels like it's going to be about maybe the shutdown. My week's going to be about the Dubai Air Show.
Your week sounds much more fun than mine, Guy, because that's like your favorite thing, whereas
we will see.
Figuring out how to fund the government is something that time and again proves very difficult to do here in Washington. So I'll probably be spending a lot of my time on Capitol Hill next week.
I hope the weather's good for you. Looks quite nice in Dubai. There's some great guests that are going to be coming up. Bloomberg Technology is next. This is Bloomberg.